Why do some investments barely move while others can rise or fall dramatically in a single day? Why do markets sometimes seem calm for months, then suddenly become unpredictable? The answer is volatility. Volatility is one of the most important concepts in investing because it affects share prices, investor behavior, and option prices. In this video, you'll learn what volatility is, what causes it, and why every investor should understand it. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. Volatility measures how much the price of an investment moves over time. Low volatility means prices move within a relatively narrow range. High volatility means prices experience much larger price swings. Importantly, volatility doesn't tell us whether prices will rise or fall. It simply measures the size of those movements. For example, one share may move between $49 and $51 over a week. Another may move between $40 and $60 during the same period. The second share is far more volatile because its price moves over a much wider range. Volatility affects every investor. Large price swings can create larger gains, but they can also create larger losses. Higher volatility often causes investors to become more emotional. Some investors panic during market declines. Others become overly confident when prices are rising quickly. Understanding volatility helps investors remain disciplined instead of making emotional decisions. Many things can increase volatility. Company earnings, announcements, interest rate decisions, economic data, political events, wars, natural disasters, and sometimes simply investor fear or excitement. The greater the uncertainty surrounding an investment, the greater the potential for large price movements. There are two types of volatility that investors often hear about. The first is historical volatility. Historical volatility looks backwards. It measures how much an investment has moved over a previous period, such as the last month or the last year. It helps investors understand how volatile an investment has been. However, it cannot tell us what will happen in the future. The second type is implied volatility. Implied volatility looks forward. Rather than measuring what has already happened, it reflects how much movement the options market expects in the future. It doesn't predict whether prices will rise or fall. Instead, it estimates how large that movement could be. Volatility affects all investors, but it becomes especially important when trading options. Because options have expiration dates, they are often traded over much shorter time frames than ordinary shares. That means changes in volatility can have a much greater impact on an option's value. When implied volatility increases, option prices generally become more expensive. When implied volatility falls, option prices usually become cheaper. This applies to both call options and put options. Volatility doesn't just affect option prices. It can also affect the bid-ask spread. The bid price is what a buyer is willing to pay. The ask price is what a seller wants to receive. During periods of high volatility, prices can change very quickly. To compensate for this additional uncertainty, market makers often widen the spread between the bid and ask prices. This means investors may pay more to enter a trade and receive less when they sell. In other words, higher volatility can increase your trading costs. Volatility cannot be eliminated, but it can be managed. Diversifying your investments can reduce the impact of any single investment. Keeping position sizes appropriate helps reduce unnecessary risk. Holding some cash allows you to take advantage of opportunities during market declines. Most importantly, having a long-term investment plan can help you avoid making emotional decisions when markets become volatile. Volatility measures how much prices move. It affects every investor because it influences share prices, portfolio values, and investor behavior. Historical volatility looks at past price movements. Implied volatility reflects the level of movement the options market expects in the future. Higher volatility generally increases option prices and can also widen bid-ask spreads, increasing trading costs. Understanding volatility won't remove uncertainty, but it will help you become a better investor and a more informed trader. If you found this video helpful, please consider subscribing. It costs you nothing, but it really helps the channel reach more people who want to build wealth, reduce risk, and become better investors. Thanks for watching, and I'll see you in the next video.